Thanks very much. Well, good afternoon, everybody. I'm going to take a few minutes to just step through essentially the sort of view of oil and gas exploration that we have at Woodmac at the moment. And I think it's fair to say that this part of our industry has taken a lot of flack in recent years, and a lot of that, frankly, has been with good reason. But the story I'm going to tell you this afternoon is essentially a positive one. It's explaining why we see the sector recovering quite nicely. I thought I'd begin with a reminder that actually the volume story from exploration is a good one. Yes, volumes in the last few years have been pretty modest, but this chart shows the volumes that different peer groups of companies, and these are the larger players in our industry, are getting from the last 10 years of their exploration investment. And you can see that towards the end of the next decade, so 2030 or so, many of these companies will be producing delivering 30% of their production from discoveries that they've made in the last 10 years. So those would be much smaller companies if they hadn't been exploring in the last decade. Those with the biggest impact tend to be some of the more active international NOCs, or some of the smaller, in this universe, some of the mid-caps, which are the smaller companies I'm showing here. But even the majors, which is that light blue line, it's getting on towards the thick end of 20% of their volumes reflect their recent conventional exploration. The exception on this chart is the large cap, so that's the companies immediately below the majors, where the contribution from conventional exploration is very small, and that's because when we look at unconventional investments and organic growth in that space, those large caps are really delivering big volumes from these plays. That's not an acquisition, that's the drill bit delivery in unconventionals. So if I put the two together, the basic message here is that about 30%, 40% of most companies in the foreseeable future reflects recent exploration drilling. It's clearly essential for most companies to sustain their businesses to be active with the drill bit. So the volume story is quite rosy, but the economics is a real horror show. The line on the left-hand side there is our industry average full cycle returns from exploration. And we may be imprecise in our measurement of some of this, but the basic message of very low single-digit returns is irrefutable. And if we look at the chart on the right-hand side there, that's the largest 40 investors in exploration across the industry on a 5-year view. I've taken the names off to sort of protect the innocent, but basically everybody that's been investing in conventional exploration has been losing large amounts of money. There are a few pockets of success. In fact, most of those have been the rather more successful companies in the unconventional plays. So good volumes, but horrendous economics has been the recent experience. Yet, I think we're already seeing evidence that we're turning a corner on the economic side, and I think there's a number of factors that collectively allow us to be a bit more confident. The first thing is much lower costs. The cost of almost any exploration program is probably less than half of what it used to be. Seismic is way lower, offshore drilling costs are way lower, most companies are running much smaller technical teams, have lower G&A. Everywhere you look, there are lower costs. When you get to developing discoveries, which obviously is an even more important part of exploration economics, those costs are much lower as well. Perhaps not by quite so much, but that's a big part of the story as well. The companies themselves are refocusing their portfolios away from difficult things to explore and really away from difficult things to develop. And so that retreat from complexity in all its forms is a big part of the story here. And I'll come on and explain a bit about what I see that meaning. We're also seeing a retreat from tough fiscal terms. There's far more opportunities out there waiting to be explored than there are well-financed explorers out there willing to drill. So any governments that are offering inappropriate fiscal terms ain't getting any wells right now, and that is not going to change. Many governments are a little bit slow to pick up on that message, but they will get there eventually. But for now, that's not an issue. There's plenty of good places to drill. And the last thing, which has been a problem in the past, and I sort of say this with sort of half an ear on the fact that ExxonMobil dropped $700 million on a block recently. Most companies are able to renew their exploration portfolio at close to zero cost compared to what it used to cost. So lower costs across the board, and an avoidance of difficult places to explore, an avoidance of tough fiscal terms, basically means that, as you can see on the cartoon there, we confidently predict much better exploration returns in the years ahead, despite the fact that we know we're going to be running those economics at vastly lower long-term oil prices and gas prices. This doesn't mean that we're going to have the same industry we used to have. It's going to be a much smaller, more efficient industry. And you can see that in the second time you've seen this data actually today. The volume data for new conventional discoveries on the left-hand side there. Those are the smallest global volumes for any year since the 1950s. But that does not mean that it's getting harder to find oil and gas. The average volume added by an exploration well has not changed. The reason those volumes are smaller is because we're drilling fewer wells. And you can see that on the right-hand chart there, which is a global creaming curve by conventional exploration wells, actually for the full history of our industry. And you can see there was an inflection point about 50,000 wells ago, which is actually around about 1980. Since then, an exploration well has been adding about 20 to 25 million barrels per well, which is the gradient of that curve. And the last 2 or 3 years are no different. So there's nothing in the subsurface that tells me it's getting harder to find oil and gas, at least not getting harder relative to the technologies available to the explorers that are looking for it. The reason we had smaller volumes in the last couple of years is because we were drilling fewer wells, nothing more, nothing less. I said that a key part of resetting exploration economics is going to be an avoidance of complexity. And this just picks up some of the themes around that. We are seeing a retreat from HPHT plays in general. They are quite complex things to deal with. And the number of HPHT wells getting drilled by explorers is far fewer than it used to be. We are seeing a retreat from the offshore Arctic, with the possible notable exception of the Norwegian Barents, which I know is Arctic, but it's not particularly tricky. But what we are not seeing a retreat from is deep water. And I'm going to come and explore a little bit why we're saying that deep water is not a complicated place to operate, which may not be something you're that aware of if you're not already involved there. In fact, if anything, the share of deep water action, the proportion of deep water wells that the exploration industry is drilling, is creeping up. And certainly if we zoom in a little bit on the last, I think this is exploration since the oil price has been low, so since the start of 2015, and the bars there are by country. The biggest volumes, the top half dozen or so of those countries, it's overwhelmingly deep water volumes. So more than half of all the volumes that we've seen discovered in this period have been in deep or ultra deep water. And in fact, the other interesting theme on here, which I'll come to in a second, is it's very largely in new plays or even new basins. So that theme of a retreat from complexity does not mean a retreat from new frontiers or high-impact exploration in new basins, far from it. So just to run through some of those, many of you will be familiar with the discoveries behind this. The biggest volumes in Egypt are that new Cretaceous reef play that Eni opened up with Zohr. Senegal and Mauritania, that's a new big gas play off West Africa. The US Alaskan oil volumes are new plays onshore there, where, as you can see, there's 2 or 3 billion barrels of good, highly commercial new oil found in new plays there. Guyana, of course, famously is probably the top new deep water oil play. I'm actually missing the Senegalese oil volumes here because they were 2014, but they very much fit into this theme of the big stuff is deep water and it's new plays. Why are some deep water plays still attractive commercially? It's not rocket science. It's really all about finding the best rocks. All exploration has always been about that, and I say that as a paid-up member of the Geologists Union. The chart here just shows reservoir quality using development well EUR, so the volume developed per deep water well as a measure, against reservoir depth. Good deep water is all about finding exceptional reservoirs at unexceptional depths. And you can see why there is so much interest in Brazil when you look at opportunities on a chart like this. A deep water well in Brazil is going to recover 30, 40, 50, even 60 million barrels per well. That is 2 orders of magnitude better than a shale well, on average. I think somebody this morning said good Deepwater spanks shale. Well, it does if it's Brazil, certainly. The dots there represent the oil projects that have been sanctioned for development in Deepwater in the last few years, or those that are fast heading that way and that we currently hold in Woodmac as a near-term probable development. There's 30 billion barrels of oil on the chart. And it's a pretty good predictor. If you know the recovery per well and you know the reservoir depth, if it's above that line, it's going to be commercial. You can get away with lower recoveries in shallower reservoirs, you can get it, but you need bigger recoveries in deeper reservoirs. Just to reinforce that point, these are pre-tax break-evens, and if I put on the post-tax break-evens, again, just showing the break-even price for those oil developments against the recovery per well. Obviously, the correlation gets a bit less robust if I introduce the complexity of different fiscal terms, but those post-tax break-evens on the right-hand side there, that's all deepwater oil. It's 30 billion barrels of deepwater oil. It's got an average break-even of $42 per barrel. And this is not theoretical projects. These are the ones that have gone ahead. Well, the other theme I picked on was the theme of frontierness, or exploration maturity. And certainly there's probably a lot of investors are quite nervous about the concept of unproven new plays, absence of any data to kind of benchmark particular opportunities against. We've just been through a big exercise at Woodmac, and we're doing a lot of work in this area at the moment. It's a big theme of interest for our clients, who tend to be the larger players in the industry. And this is 40 years of data looking at the volumes, it's that same volume trend, but according to the maturity of the play at the time the exploration well was drilled. And what you're basically seeing is that around about half, or getting close to half of the volumes, come from variously frontier plays. Frontier unproven here means up to and including the first discovery in the play. Frontier proven means up to but before the first barrel is produced in the play. So you can see that about 40% of the volumes in the last 4 years have come from plays from which there has never been a barrel produced. In fact, the longer run history in the industry is even higher than that. Nearly 2/3 of all the barrels ever discovered in the oil and gas industry were discovered before the first barrel was produced in their play. At the other end of the spectrum, you can see various sort of emerging and then established and mature plays. And there's a bit of a growing theme with more action in that late mature stage of exploration, and perhaps somewhere between 10 and 20% of the volumes coming there. And of course, that's companies taking advantage of infrastructure-led opportunities in relatively mature basins and plays. But as we saw in that data for the last couple of years, can't stress enough, new frontiers are absolutely key to most companies' success in exploration, certainly the big guys. We can cut that data another way, just thinking about when is the best time to explore a play. There's kind of 2 data trends on here. We're stepping from left to right through plays as they go from being that unproven frontier all the way through to being a late mature play. The light blue bar is the average discovery size, and it's probably no great surprise to see that that gets steadily smaller as plays mature. So on average, the largest discovery size is the first discovery in a play, and certainly by the time you get to late mature, you're way, way smaller than that. But there's a trade-off, and that's that dark blue line, which is the well success rates. So the sort of long-run average success rates for exploration wells is about 1 in 3. But it's much worse than that if you're in an unproven frontier, and it's a little bit better than that if you're in a mature play. So the grey bars, which are perhaps a little bit hidden, is maybe where the real message of this chart lies. It's the product of those 2. So it's the volume added per well, according to where you are on a maturity scale. And it shows you pretty clearly that the sweet spot is in proven frontiers. So that's the optimal combination of discovery size and success rates. And of course, everybody wants to be in a freshly proven frontier. And good luck with that as a strategy. I suggest that for most companies, if you want to be in a proven frontier, the only way to get there is to open up a new frontier yourselves. But not necessarily so. Well, who's doing this kind of exploration? So this is just the last 10 years, and it's looking at the proportion of different companies' wildcats according to these different maturity statuses. And those on the left are those who tend to be more active in the more frontier ends of things, and those on the right are the other end of the spectrum. And when you look right over at the left there, and you see Cairn Energy, you see Tullow Oil, Woodside, Hess, Cosmos, most of us are not going to be surprised to see that those are the more adventurous, high-impact exploration names that we know and love. But not far behind them are most of the majors. And in fact, since we've seen the retreat from exploration of a lot of the industry, more and more in terms of market share and high-impact exploration is coming from our friends, the majors. In fact, those are usually now the guys to watch in any big opening for exploration. So we've heard many different views on different kinds of exploration for small companies and different ways for small companies to thrive in exploration, and I wouldn't argue with any of those. But certainly one theme that I quite like for smaller exploration players is have one eye on what the majors want, and if you can, go where the majors want to go, because very often that will give you a great early monetization option. If you've captured some acreage that majors like and you can bring them in with you, then you don't have to wait for a very long time to get your money back. This is just a chart showing the high impact acreage that the majors have signed, again, since the oil prices have been low. It's not bang up to date, so I haven't got all that latest Brazilian acreage that many of them have been picking up at considerable investment in the last month or so. And I would also caution not to dwell too long on the absolute heights of these bars. The stripiness of the bars is almost as important as their height. So almost to a man, maybe Chevron is the sort of exception here, but almost all of these majors have been picking up big commitments in high-impact exploration plays in many different countries around the world, typically several different new entries that they've made in the last couple of years. Not all of those will be drilled, but most of them will. They have been doing absolutely what they should have been doing, which is reloading their portfolios while the price of acreage is at historic lows. This is basically the same data, but just showing you the water depth sector of that acreage, and lo and behold, most of it is deep water. Most of the majors can't get enough of high-quality deep water opportunities right now. So hopefully you've taken from my comments that our view is that exploration has reset its economics by dropping, frankly, the difficult stuff and focusing on high-quality rocks in good plays, and by taking advantage of vastly lower costs in almost all of the different activities. That really has led us to a position where most of the industry is either focused on the deep water sweet spots or it's focused on the onshore shale sweet spots. We're absolutely confident we're going to see a recovery to full cycle double-digit returns as an industry average, and that's not dependent on a price recovery from where we are today. And because of that, I think conventional exploration absolutely has a place within a diversified upstream strategy. It is not going to be a return to where we were perhaps even 10 years ago, where most companies, most of the time, looked to replace essentially 100% of their production with new conventional exploration. It's probably about half of that. But a more efficient industry at that sort of scale is the future. Thanks very much, and I'm happy to take any questions you may have.
Thanks, Andrew. Do we have any questions? We have time for one. Does anyone have any questions on that? Well, we've got Andrew on stage. Here we go. Please, yeah.
Is it on? Thank you, Andrew. Bob Lambert from Jadestone Energy. Your final point there about focus on deep water sweet spots. I'll just do that part, not the onshore. Of course, for it to be a sweet spot, someone had to drill the first well. So what about the undrilled sweet spots?
Well, there are plenty of drilled on the sweet spots, if I could call it those. So there's plenty of places where the early wells have not given encouragement that either the resource is there, or if it is there, it can be developed with relatively few wells. And so I think, you know, there is a focus on going where discoveries, if they are made, can be commercially developed, and that big part of that is reservoir productivity. If it's gas, obviously the big part of it is the gas market as well. And I didn't talk about that, but no, let's not make any bones about it. This is exploration, and there's plenty of places where various things were missing, and we move on. There was another question over here. You still want to?
Another question here.
If we have time,
we do.
I just wonder what how you build into your forecasts and outlook the changes we've got in terms of the outlook with carbon emissions and therefore the life of different discoveries. So the difference between if you're looking for something that's going to have a 10-year life compared with something that has a 40-year life, and the visibility of monetizing the full asset.
Yeah, so I mean, I think you raise something which, in most of the deepwater oil plays I see, I don't really detect much nervousness from the big operators around. But I contrast that with something like the offshore Arctic, where that was maybe just yet another reason why the offshore Arctic has fallen away. Because if you're looking at a 10-year exploration program, and you know another 5 or 10 years beyond that, before you might get to commercializing a discovery, then you really are forcing the operator to say, well, actually, is anybody going to want this hydrocarbon when I get to it? Whereas I think in a straightforward deep water play, and I'll pick on Guyana, but there are plenty of others, if you're looking at a 3-4 year lead time from discovery to development, chances are the world isn't going to be so different when you're ready to do that.
Okay. Anyone else with any questions? Oh, one last one. I think we squeeze one in.
In the seismic acquisition market, which seems to be on its knees at the moment, particularly marine, is there a dichotomy with what you're saying about the majors and their demand for deep water versus the money they're putting into upstream acquisition?
I think and I'm no particularly great expert on the supply and demand dynamics of seismic, other than that clearly it seems to be terribly oversupplied at the moment. But I was with a head of exploration for one of the majors 2 days ago, who was telling me he's spending $200 million a year on seismic, and wants to understand if he's ahead or behind his peers at that sort of level of investment. They know that underinvestment in seismic is a mug's game, and certainly in deep water. And I think, I mean, there are many factors here, because although I showed you data there of big companies capturing a lot of acreage, they're capturing it without the commitments that they perhaps once would have had. I think that there's two consequences of that. One is they will take the plunge with a little bit less rigor on the seismic ahead of making those commitments, and the second is they may well commit to less new seismic in doing so. So there are a couple of issues there for the seismic companies, but the basic need for seismic hasn't gone away. And so the fact that deepwater economics have reset themselves is broadly positive for the seismic guys.